Can a seller pay closing costs for the buyer? Yes, but there are limits to how much a seller can contribute, as well as what those funds can actually be used for. And you should also know, even though it sounds like free money, it's not really. If you're considering buying a home, even if you have a ton of cash saved up, you're going to want to watch this video. Every home buyer should be familiar with the things I'm about to tell you. My name is Michael. I own a local real estate brokerage here in the Dallas area, and if you're looking to make a move in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. First of all, I want you to stop thinking of it as the seller is paying my closing costs. Think of it this way. There are two numbers happening here. One is the actual number you're netting the seller, and the other is the amount of closing costs you'll be financing in the loan. For example, a house is listed at $400K. You offer $400K on that house, but you ask the seller to pay $10K of your closing costs. What's really happening here is you're offering the seller $390K and you're financing $10K into the loan, for a total of $400K. Does that make sense? The seller has agreed to accept your offer of $390 while allowing you to finance $10K of your closing costs into the loan, for a total purchase price of $400K. Now, there's one bit of quick math I'm gonna need you to memorize for the rest of this video, and this is a good number to remember in general if you're considering buying a home. Every $10,000 increase on the loan raises your monthly payment by about $70, and that's including taxes, interest, and insurance. Again, this is not exact math, but it's a good, quick, easy ballpark reference. So, by asking the seller to let you finance that $10K into the loan, your monthly payment will be about $70 higher than if you had just offered them flat out the $390K with no seller concessions. So, you can either pay your $10K closing costs cash out of pocket, or you can finance it for $70 a month. This for me is an easy decision, and I always ask, what's easier to come by, $10,000 or $70 a month? Well, the $70, obviously. So write that math down, memorize it. We're going to use it again here in a minute. $10,000 in the loan equals $70 a month. And you can use this quick math anytime you're looking at houses online. For example, if you've already gotten approved and you know what your payment would be on a $400,000 house, but you see one online for $420,000, you can just know that house is going to be about $140 more a month than what I was quoted for a $400,000 house. Okay, now what would be some good reasons for the seller to pay your closing costs? When would you want to use this? Number one is if you literally don't have the cash to close. Let's say you're a first-time buyer and all you have saved is your 3% for a down payment, which on a $400,000 home would be $12,000. Well, that would be the perfect case to finance all of your closing costs into the loan. By doing this, you can buy a $400,000 home with literally only $12,000 cash. That's pretty crazy, right? Another good time to use this would be to do something like buying down your PMI to lower your monthly payment. PMI is a mortgage insurance that the bank requires you to carry anytime you put less than 20% down on a house. I'll do a more detailed video on PMI later, but for now, all you need to know is, in my experience, buying down the PMI is usually the cheapest way to lower your monthly payment the most bang for your buck. Now we're about to use that quick math here again. And this is a real life example that I did once. I was able to spend $3,500 to buy down my PMI up front, and this lowered my monthly payment by $100. Now remember, if I would have put $10,000 more down as a down payment, it would have only lowered my monthly payment by $70. But instead, when I use only $3,500 to buy down the PMI, it lowered my monthly by $100. So instead of spending $10K to lower my payment $70, I spent $3,500 to lower it $100. So I got to keep $6,500 more in my pocket, yet still lowered my monthly payment $30 more than if I had put down an entire $10,000 more as a down payment. All because I spent the cash on buying down PMI instead of putting it as down payment. If that's confusing, ask in the comments below. So what I'm getting at here is, in that scenario, I could have asked the seller to pay this $3,500 to lower my monthly by $100. So the full math that's actually happening is I'm financing $3,500 into the loan, which raises my monthly payment by about $25. But because I'm spending it to buy down my PMI, that then lowers my monthly payment by $100, which results in a net $75 less per month payment, all without spending any more cash out of my own pocket. Again, if you're confused, I know it's a lot, the comments are open. Another reason would be buying down your interest rate. This is basically the same concept as buying down the PMI. With interest rates as high as they are, it's gotten pretty cheap to buy down points. So there may even be some kind of combination where you want to buy down part of the PMI and part of the interest rate. Just ask your lender, how much would I spend to buy down my PMI and how much would it save me a month? And then how much would I spend to buy down my rate and how much would that save me a month? And they should be able to send over a few scenarios. And if you're not pre-approved yet and haven't spoken with a lender, shoot me a text and I'd love to connect you with a great one. Another good reason to do this would be if the house is needing repairs or some updating. A lot of times sellers don't want to do repairs. And honestly, do you trust them to do the repairs for you? A better option might be you get the bids for the work and you ask the seller to credit you however much that is. Then after you close on the house, you pay the contractors yourself from that amount that was credited to you at closing. Another example, let's just say the house that you're buying is perfectly fine, you just happen to not like the floors. So you want new floors and that's going to cost you $10K. Rather than having to spend that $10K out of pocket, you can finance it in the loan by the seller paying $10K of your closing costs. Again, this will raise your monthly by about $70, but that's way easier than having to come up with an extra $10K, especially after you've just paid all this cash to close on the house. And the way this works is the $10K seller concession means you have to bring $10K less to the closing table. So you keep that $10K in your pocket. Then after you close, you spend that $10K on the new flooring. So you're still spending all of your cash in the end, but you're ending up with new floors. So what are the limits to seller concessions? The first one is the seller cannot pay any of your down payment. A family member can. You could borrow against a 401k or an IRA for your down payment. You can even crowdfund your down payment. For example, doing a GoFundMe for your wedding, asking everyone to contribute to a gift for you to be able to have a down payment on a house. But neither the seller nor any of your friends can contribute anything towards your down payment outside of what I just outlined. Next, there are limits to the dollar amount that sellers can actually contribute to your closing costs. On a conventional loan, for example, if you're putting less than 10% down, then the maximum amount a seller can contribute is up to 3% of the contract price. So on a 400K home, the most a seller can contribute would be that 12K. But if you're putting more than 10% down, the seller can contribute up to 6%. And if you're putting 25% or more down, the seller can contribute up to 9%, though there are not many scenarios where you would ever need to go anywhere near that high. If you're getting an FHA or VA loan, right across the board, regardless of your down payment, the seller is going to be able to contribute up to 6%. And if you're an investor doing either a bank statement loan or a DSCR loan or something like that, it's going to vary based on your investor. But generally, they are more lenient since you usually have to put 10% or more down anyway on those loans. They'll usually allow up to that 6%. The next limit is you have to actually be able to spend the money you ask for on your closing costs. You can't just ask for any random amount. If you put in the contract that the seller is contributing 10K to your closing costs, and then your closing costs actually only end up at 8K, then the seller gets to keep that extra 2K for free. So for example, with our 10K flooring update, just because the flooring will cost you 10K doesn't mean you can actually get all 10K from the seller. You can only ask for the actual amount of your closing costs. So if your closing costs are only 8K, but the flooring is 10K, all you can ask for is the seller to pay that 8K, and then you have to come the extra 2K out of pocket to do your floors. But that's still way better than having to pay the full 10K out of pocket. So make sure whatever numbers you put in the contract, you actually have that much in closing costs. And here are a few bonus tips. The first is asking for seller concessions obviously makes your offer weaker as it's netting the seller less. So if your market is seeing a lot of multiple offer situations, you may not be able to use this, or you may just have to go for the less desirable homes that are sitting for longer in your market. Another bonus tip is you can actually use this to offer above the list price. So for example, if a house is listed at 400K and the seller is not going to take a penny less than that, you can actually offer 405K and have the seller pay 5K in closing costs. This nets the seller that 400K number they want and allows you to finance 5K of your closing costs, so it's a win for everyone. The only time this one may be an issue is with the appraisal, but most of the time this is going to work out just fine, so I'm not going to go in detail about that. If you have questions, leave a comment. And also, please let me know what other real estate questions do you have. I want to make sure I'm making content that is relevant to you. And again, if you're looking to buy in the Dallas area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. Thanks for watching. I'll see you in the next video.